The second stage is now our growth stage, and the growth stage is always the most favored by growth investors. No matter what, if you invest in United States stocks, investing in growth stocks is the key point, so it's something you can't overlook. So for this part, I'll explain some of the characteristics and talk about real-life examples, changes in financial indicators shown in those examples, and how we should look at sales figures.
I'll explain them for you.
I will do. This growth phase is when I avoided the introduction and started to mature to some extent. I captured this point here, and you can clearly see the turning point where things completely take off and accelerate. The early stage when the inflection point occurs is called the initial stage of entering the growth phase.
That's how it goes. High growth.
Even if you invest at this stage, I think there is a period where you can invest alongside the company's growth for quite a long time. So at this time, products and services are sold rapidly, the customer base expands, and there is a huge increase in investment as well. It's a scenario requiring a steady influx of investment capital to sustain rapid expansion. The company is making money, but even with that money, it's entering a growth stage where investment alone is not enough. At that time, whether you borrow debt or get money from shareholders, you keep putting in money, and through large-scale investments, you continue to accumulate more and more growth energy.
These kinds of things.
We can check these things in the financial statements. By looking at the financial statements, we can see at what stage the company is currently at. Next, we must focus on business activities in the cash flow statement. I always stress the importance of cash flow and business activities. At this time, we convert to plus with a band, and there are no growth stocks that do not convert to plus. So in the very early stage of growth stocks, there may still be some minor minuses, but at the division stage, they quickly convert to positive operating cash flow in a short period of time. Operating cash flow turns positive before operating profit and net profit do, even though the cash flow statement still shows a deficit during this period. I think this is the best point to enter in the early stage of the growth period. As the company is still unprofitable, people remain hesitant, but
The stock price has already
risen quite a lot.
That's right, Georgia.
It's a company, but the stock price has gone up this much. Will it go up even more? But it's always the hardest to buy when the stock is at its peak. And since you never know how far it will go, that's why this point of converting cash into stocks at the beginning is really important. Next, the part you need to pay close attention to is this. The operating profit margin and the earnings per share growth rate are important. For growth stocks, the sales and earnings per share growth rates need to accelerate. In the early stages, growth stocks just enter the initial phase and a turning point is created. But within 2 years, if the sales growth rate doesn't pick up, it's not good. For example, if the growth rates are 30%, 28%, and 20%, then it's unlikely to be a true high growth stock. Real high growth stocks usually show growth rates of 30% to 50% or more, and they need to maintain that level for at least 3 to 5 years straight.
That kind of growth rate.
Since we can check the numbers in the consensus data, it's important to look at that data and see if the stock really matches the kind of growth stock I want. So in the Sonic calculation, we look at the sales growth rate, then the part where it transitions to cash flow, and then in the consensus we check whether the sales and earnings per share growth rates are slowing down or accelerating. The key point here is whether I can buy at the early stage of growth, and that's a very important part. For valuation investment indicators, metrics like price to cash flow ratio, which considers business activity and cash flow, or price to sales ratio are crucial. So for example, I brought up Nvidia and took a look at it. If you look at Nvidia in the inflection point, the future growth rate numbers
Come out like this.
If you look here, the stock price changes are a bit big. The reason is when the growth rate accelerates or slows down, the stock price tends to drop a lot in response to that. But in the case of NVIDIA this year, for example, the expected sales growth rate or the earnings per share growth rate is 53%, which is still quite high. Having a sales growth rate of 53% means the company still has the characteristics of a growing business. But the part we need to pay attention to as investors is whether the growth rates after this will slow down. So when that time comes, there will definitely be moments when we have to get out. So focus on that part and monitor it closely. Now let's move to the site and I'll explain while we look at the actual screen. If you look at the media, Here, as you can see in the category progress, the future growth rate is very high at 85 points, and the part we need to pay attention to in this smart score is the past 1 year score prediction for this growth rate. So when it comes to growth, if you ask how these future growth scores are shown, it's either that the growth score is rising, or if not, it's being maintained at a high score. So when we say it's being maintained, it means that the growth is being sustained at a steady and high rate. Companies with scores rising from 35 to 65 to 85 and those maintaining a score of 85 are both considered to have significant growth potential and can be evaluated accordingly. So if you compare it to a year ago and see how things have changed, the data is showing us that MB is still maintaining its high growth rate. And if you look into the financial statements and examine the characteristics, let me show you a financial chart. A financial chart is basically made from the financial statements.
That's what it is. So
I created a chart using the financial statements. It shows that at certain turning points, there are sections where values decrease sharply.
that's what it is. So
Growth stocks have to show this kind of pattern. That's what we call growth stocks. Instead of a straightforward increase, look for a pattern where a turning point forms, followed by a dip and then another rise. These distinctive characteristics are what you should watch for. If we go back to the financial statements and take a closer look, here I'll scroll through this section over a period of time. I'll scroll through it in sequence.
if you look here,
You can see that the growth rates of sales were quite high at this time. But if you look at 2024, the growth is even more remarkable. So both 2023 and 2024 mark the early stages of this explosive growth period, which is a turning point, and that's exactly what we're seeing in 2024. As conference data emerges, it's crucial to acknowledge that this type of data transformation signifies a turning point for the company. We're investing now with a focus on 2026 and 2028.
so here,
If you look as we enter a phase where things double and business profits triple, these kinds of situations appear where we can rapidly move into a growth phase. The operating cash flow curve shown at the bottom displays a significant increase. It starts at 4.7 billion won rises to 5.8 billion won, then 9.1 billion won before jumping to 28 billion won and finally reaching 64 billion won, showing tremendous growth.
so that's why
So these kinds of changes begin to occur, and if you examine the financial activities afterwards, here,
now miners, it continues to rise in financial activities.
when the minus increases, it means that cash is flowing out in the company's financial activities. So in this case, if you look at it closely, there are two main reasons. Either the company is paying back loans or returning money to shareholders as compensation, or they are buying back their own shares and reducing capital or paying out dividends. When they do this, that's why the minus appears here.
That's why.
Now, it's in the form of preferred stock. So when will our growth stocks come to an end? This is the point where you need to be most careful, and among them, the most important part is to check the sales amount, earnings per share, and the growth rate trend. That's the most important point. So for that point, you all need to come into the summary, and at the bottom, we will show you this data.
So the sales amount,
This year it's 53%, then next it's 25%, 16%. So if you look at it now, in 2 years it will be 18%, 16%. This means it's entering a phase where you can't really call it a growth stock anymore. So at this point, unless NVIDIA can make a comeback with a new technology or a new product, it's definitely entering the stage of corporate growth where that's going to be difficult. But since we've come this far, people always say that since this company had a price to sales ratio of 30 times, it should be given 30 times even now. The critical period when a major event could occur is precisely 1 year from now, so we must be extremely cautious during that time. But these consensus data are still based on expectations, so they keep getting updated and changing. These numbers could go up or down at any time, but it looks like next year we're entering a period where the growth rate will decrease a bit. That's how you should see it. Looking at the earnings per share growth rate, this year it's 38%, next year it's 33%, and the year after that it's 17%. If you look at the earnings per share growth rate, the phase where the initial high-speed growth slows down could arrive in about a year. So as the growth rate slows down and the overall valuation approaches a fair value, if we start seeing sell signals in our system, I think it becomes more important to consider strategies for actually realizing profits at that point. If you look at our trading signals, we bought Nvidia shares early on, but as the valuation became high, we couldn't hold on and couldn't match the continued rise.
and then really,
I remember introducing a buy signal after a really long time.
That's right. In May,
On the 9th, it appeared at $117, and now it's up about 20%. Even looking at it here, if you bought here, fortunately the stock price is going up. The reason the buy signal appeared was because it was a valuation issue. Historically, when the stock remained undervalued for an extended period, people couldn't buy it, despite attractive prices and growth potential. However, when the price hits the bottom of the undervalued range and the supply begins to loosen, that's the buy signal. With the supply now loosening, this is the optimal time to make your move and buy. Currently, the valuation is close to the appropriate level, indicating it's at a fair value, not overvalued. Then, is it still in the early growth stage, or is it at the end of the growth period? How can you tell? Please pay attention to the score indicators that help you determine this. If you look here, you can see how early growth stocks appear. The graph shows this triangular shape. I explained this once before on LessEP when I talked about how to identify early growth stocks. I did this with Nvidia and I did this with Tesla as well. But when this company's growth rate slows down a bit, or even if the growth rate doesn't really drop, once the company starts making a lot of money, its profitability improves, its profit margin gets better, and its competitive power gets stronger, so it starts to show this kind of trapezoidal shape. Among growth phase companies with a trapezoidal shape, Nvidia is currently the sole example. This explains the scarcity of other companies exhibiting such a trapezoidal pattern. Ideally, an early stage growth stock should develop in a triangular shape. If it further grows and becomes a trapezoid, it has surpassed the mid-stage growth phase. However, if the growth rate starts to decline, caution is needed. Viewing it from this perspective can be beneficial. Then, where should you look to find these early stage growth stocks? In this way, in Discovery.
Go in here.
If you go into Seongjangju, it's called the Discovery Seongjangju. If you press the menu,
The triangle I drew.
you can see all the shapes. As you can see here, the DoorDash triangle, the cube triangle I recently introduced in a video. And honestly, I don't even know what company this is.
Coding triangle.
This plot shows the projected earnings per share growth rates for all the companies, including Tencent Music, a company called EQT. And companies like this are what we call early stage growth companies. So when we try to find early stage growth stocks as indicators, it's really difficult because you have to put in all the numbers and find them yourself. If you use this menu, I think it will be very helpful for you to find growth stocks.
I think many of you are probably most interested in stocks that are in this second growth phase. For example, YouTube channels that used to be popular before also had a lot of content like Find the Second Tesla. If you look for early growth stocks in the investment recipe you just showed, I think you'll be able to find them. Among the things that Mr. Dapio just mentioned, there is one part that I completely agree with. When investing in growth stocks, switching from operating cash flow surplus to net profit surplus, that's really important. It was about 2 years ago when I went to Korea and gave an offline lecture. That's when I first started talking about something called pre-turnaround. Before that, there wasn't anything like that. So at that time, I introduced top 10 and then top 5. At that time, there were 2 companies that were expected to switch from a surplus of operating cash flow to a deficit. And if the order backlog didn't last long, they were expected to fall into the red. One was Palantir and the other was Uber. So 2 of them went into the beehive. And at that time, Jugaga was $15 and Uber was $17. Now both are over 150, both have become 10 baggers. So just like what the representative mentioned a moment ago, I think companies that are transitioning from negative cash flow to positive cash flow are worth paying attention to for those watching this broadcast. And of course, even if growth is good and operating cash flow turns positive and you buy in, as you mentioned earlier, what's also important is the sales growth rate and then the net profit growth rate. These need to continue trending upward. If you look for companies in that way, maybe we might be lucky enough to directly find the next Tesla, the next Palantir, or the next Uber ourselves. So we've looked at the entry and growth stages. Now, what's the third stage?
It's the maturity stage. When we usually talk about the maturity stage, we often mention value stocks, right? We talk about them a lot like this. For companies in the maturity stage, as we talk about mature stocks, Once they enter the maturity period, basically the company's size becomes quite large, or the sales growth rate, or the market and industry itself reaches a certain level of maturity.
These kinds of patterns.
These are the types of companies that are mostly included. So I'll use a chart and explain a bit more. For the mature stage company, I brought in a company called Google as an example. At this stage, the growth rate usually enters a range of about 10% when the periods of sales growth above 30% come to an end, and the growth rate gradually decreases to around 10% to 15%. That's when we say the company has entered the maturity stage. So once a company matures to this point, from then on, rather than seeing big changes in the stock price, the valuation tends to fluctuate between high and low, depending on the level of profit, moving within a range of high valuation, low valuation, high valuation, low valuation, and so on.
It's rare for it to become extremely overvalued.
Although still in good condition, it's fair to say that the phase of the stock price rising alongside the company's value has ended. So if you actually look at the smart score, you can see that the growth section here is a bit empty. That's because most of the companies called moat are already mature companies. But instead they have something else firmly in place. They've been financially successful with strong profits, margins, cash flow, and stability. While other areas remain solid, their growth has slowed somewhat. That's their current structure. For mature companies, a future growth potential score of around 45 points is sufficient to be classified as mid-level growth stocks. NVIDIA is a bit unique in this case, even when you compare it to others. If its growth potential is still over 85 points, that's really an exceptional case. Companies at this stage, even if mature, are usually considered mid-level growth. Most companies reaching this point almost always see their growth potential drop to this level. No growth potential.
If that's the case,
Here, because growth has stopped, it's a bit concerning that a lot of investors tend to invest during this period. Stock prices often struggle to rise and frequently fail to match the performance of the S&P index. In the end, at this point, we need to look at whether it's possible to recover growth again, but this depends on the next stage, which is the economic cycle and liquidity. So let me explain that a bit more.
I'll explain. Google.
Even in the same case, if you look at it, next year's expected sales are about 10% higher than this year, so you could say it's just steady growth. However, in the case of Google, basically you can see a stable sales growth rate of around 10% before and after, but if there is no additional investment for the future, instead a higher profit margin may appear. So, although the profit margin does go up, in the end, if the sales growth rate drops, the profit margin will inevitably follow and drop as well. In the beginning, as the sales growth rate stabilizes, there may be a temporary improvement in profit margins, but it's not easy for that improvement to continue steadily. It's not easy. So the important thing here is whether this company will move on to the next stage, or if it will mature and enter a new phase, or if it will go into decline. The part where you decide that is right here. Ultimately, to progress to the next stage, you must engage in either R&D or M&A. This will be evident through a swift rise in tangible assets. Or if the cash flow from investment turns negative, that means the company is making investments.
That's what I'm talking about. Large scale.
You need to see a return at least once on your investment to enter that phase. Or whether you do an M&A or not, the idea that this change will continue without anything happening. If you keep going like this and your growth momentum slows down, in the end, you have no choice but to enter a period of stagnation. And if I made a mistake and invested for too long, I could end up in a situation where losses keep piling up. Not all mature companies are the same, but for those that have reached maturity, it's crucial to assess if their business model will lead them to become that type of company. That's the key point I wanted to stress. I'll talk a bit more about these parts when I go over the stock calculations. The successful development of the next product or service version will be crucial. Even in the case of Nvidia, I think it will enter a mature period after 2 years. So after 2 years, the question is whether another Nvidia will come out with different products that can lead the market or not. Recently, things like BlackRock and similar launches, it's uncertain what kind of ripple effects they will have on the market or what changes might actually occur. But I think such things need to emerge for deregulation to enter its proper timing. Because net profit and cash flow are steadily coming out in the valuation indicators, I think you can check things like price-earnings ratio or price-to-cash flow ratio without much difficulty. Then let's move on to the income statement and take a look at it together. Let's search for Google in the income statement. When I go into Google and click on the financial statements, if you look here, Those of you who have studied the income statement with me before will notice that Google has something called revenue here. So as I explained the difference between cost of sales and operating expenses, cost of sales is the expense incurred when manufacturing a product, and operating expenses, simply put, are the expenses incurred after making the product. Service businesses generally do not have a cost of sales because they don't have material costs. Then it's reasonable to wonder why Google, which we clearly know is a service company, has a cost of sales. You understand financial statements well. Now, when you see a service company with a cost of sales in their financial statements, it may seem unusual since manufacturing companies typically have this, but service and financial companies usually don't. Why is that the case for service companies? Now, these kinds of things can only be found in the original financial statements from electronic data gathering, analysis, and retrieval. If you look there, you can see all the detailed content, but I looked them up for you instead. When I looked it up, there were about three main things. The first one is data center operating costs. To build and maintain a data center, you need to make a lot of capital investments. Things like servers and similar equipment are included as assets on the balance sheet. Next, the second one is traffic acquisition cost. What this means is that, for example, to make Google the default search engine on Apple's basic search engine, Google pays Apple an annual fee every year for this service. The reason Google pays this fee is because search ads are so important to them. They consider the traffic acquisition cost they pay to Apple as a necessary expense to increase their search ad sales. So the commission they pay to Apple is included as a cost here. That's how you can look at it. The third one is that Google does a lot with YouTube. The revenue share they provide to YouTube creators is also counted as a cost.
Is included as well.
The costs for the search engine and data centers provided to Apple are the most significant, although this part may not be very large.
And that's the main reason anyway.
Service companies usually don't have this, but Google has a special structure for this kind of business. So even though it's a service company, it still has costs. So that's how they make their point.
If you look, Sonny,
If you look at case answer a bit more,
You'll see it more vividly.
I think you'll be able to enjoy it.
and next,
Next, watch out for research and development. Cutting the research and development budget won't work. For industries like this, a reduced R&D budget means there's nothing left to research. Let me take a look at it from a time series perspective. From a time series perspective,
If you look, the research and development budget
it's still about 10 like this.
% each time.
It's a structure that keeps increasing like this. So last time, when we worked together with our representative and us, Google,
Goran, again.
the reason we introduced Google as a company worth watching, a company that could make a comeback, is because they continue to invest in research and development. They keep using that research and development and don't give up. These parts are expected to lead to sales growth and development in the future. If you look at this company in the past, the sales growth rate gradually decreased, but recently you can see signs that the sales growth rate is recovering again. You can see that the overall growth rate is being driven by certain points, and there are parts that are growing thanks to the current investment in research and development. If you look at the bottom, you'll see that in the company's financial statements, the total assets are about 450 billion won.
And among them,
The largest portion is liquid assets, $184 billion. This means that 40% of the total assets are held as tangible assets. Tangible assets basically refer to things like servers, factories, and machinery. They build data centers and run servers there, so these types of tangible assets have to increase. In reality, the money that flows into these data centers is what allows Google to operate and develop artificial intelligence engines. So in reality, you can't really cut back on investment in these tangible assets. So when you look at companies that are in a growth phase, it's important to see if their R&D expenses and tangible assets are increasing. If both of these are going up, but their sales aren't, then it's fair to say that industry might be finished, right? They're still investing in tangible assets and increasing their R&D spending, but it's not translating into sales. In other words, the growth rate of tangible assets and R&D expenses is not being matched by sales growth. That means they've developed new products or made investments, but you have to see it as the market isn't responding. That's why those points become risky points. First of all, if you look at Google only by its risk assets and R&D investment growth rate, it still seems like a company that's going through something. But recently, since their sales growth rate is recovering, we can interpret through this financial statement that they've created something that's getting a response from the market. When I first look at a financial statement, I'm not just looking at numbers, but the results of the company's business activities. I use these numbers to infer the company's activities and predict what might happen in the future. That's why it's crucial to use financial statements in this manner. It's not just about discarding the past, but rather it's important to see what kind of future the past performance suggests. That's one of the key points of providing this information. So when you look at expected results together with the actual numbers, it's very important to compare them side by side.
Depunim, I think today's broadcast will need to be a bit longer. Google performed exceptionally well during the current earnings season. Their cash reserves are increasing, and their research and development expenses are also rising. As a result, their sales are going up as well, so investors are feeling reassured. This is how we should interpret the current situation. Could a similar situation happen to Apple, which is also in its maturity phase? Should we check that too?
I'll make sure to take a look at the expected questions today as well. Actually, things like this are interesting. So,
How are companies?
how we can actually interpret the data ourselves and see how Apple is coming out. Let me show you that first. First of all, it would be good for those of you who are new to our diagnosis scores to take a look. If you look here and compare it with Google, you'll see that in terms of financial stability and profitability, both are similarly good companies. But the problem is that the growth score is only 10 points. So compared to Google, which has 45 points, the expected growth is significantly lower. So it's almost at the end of its growth phase. That's why, unless Apple comes up with some innovative elements, it might take quite a while to break out of this maturity stage. So which companies are currently transitioning from maturity to a new growth phase? So Broadcom actually got there much earlier. But if we only look at the big companies, Meta actually went a bit ahead first, and then Broadcom came in second. Right now, Google seems to be showing some signs of that, and Microsoft appears to be slowly and steadily working hard to move to the next stage. Even though we don't know if anyone can catch up like Google when the artificial intelligence era comes, for now, it seems like the company that's leading the way is Google. Apple is kind of at the very end of the line among these big companies, so I feel like they're a bit late to innovation. So let's first take a look at the actual data numbers to see how this shows up in the earnings calculations. The sales growth rate is 4% this year, 5.9% next year, and 6% the year after. Even over the next 3 years, sales growth is expected to stay around 5%.
That's what I'm saying. And then
Here you can see that there still aren't any key figures of change in the market who can pull this up with just two hands.
that's what's happening. Next.
If you look at the earnings per share growth rate, it's 18%, then 9% the following year, and the year after that,
10%. So
there are some parts that make it a bit hard to see it as a growth stock, so
these kinds of changes.
I think they need to happen. Next, let's take a look at the cash flow statement and analyze it.
If we compare them here,
If you look here, in the case of research and development expenses, you can see that nothing was spent here either. If you look in 2021 and 2022, research and development expenses were relatively high, and in 2022 and 2023, they were just over 10%. But then in 2024, you can see that it's not even reaching 10%. That's the growth rate. So research and development expenses have decreased now, and the overall growth rate of research and development expenses has also gone down a bit.
the second one is
This company also has original prices, but of course, since it's a manufacturing company, it must have original prices. If you look here, when you look at this company's investments, it doesn't seem like they're investing much in things like intangible assets. The reason is that this company outsources all of its production and similar things, so it probably doesn't need a huge amount of facilities or things like that. So we can't just say that Apple doesn't build factories because their tangible assets aren't increasing, right? So that means we have to look at each company's financial statements differently. The key points to consider are the company's core business and whether they own factories. These factors impact how we should analyze the company. So, in the case of a company like this, rather than just looking at famous assets, I think it's important to see how the company is actually utilizing its assets overall. The company's total assets amount to about $360 billion. Out of that, $360 billion, if you look at it, the highest proportion is in long-term investments, short-term investments, and cash, these three categories. If you add all of these together, it seems like it would be about 50%. So about 50% of the company's assets are related to cash. Whether they use this to actively pursue M&A or take a more aggressive approach, I think changes like these are necessary. Even if you look further down, this company continues to be conservative, holding a structure where it uses a lot of cash for things like self-investment. So while the company's value is being maintained that way, ultimately there needs to be clear growth in actual sales. But compared to the increase in R&D expenses here, the sales growth rate is measured on a yearly basis. And if you look from 2020 to 2021, there was a significant jump in growth. Every time a new product comes out, there are definitely periods where they see a jump every few years.
New versions.
From 2022 to 2023 for the first time, the sales amount was impacted when they came out.
Has reversed and
If it can't grow significantly in 2024, it won't break out. This stagnant situation has lasted 2 years. Starting this year and even into next year, the sales growth rate is expected to hover around just 5 to 6%. Currently, compared to Google, it doesn't seem too difficult to come up with a new product or something that fits the latest market trends.
this kind of thought.
That's what I think. So I think you might be able to see Apple in the Office suite as well. If you look here, you can see that it's a bit stagnant. If you look here, it's just flat. And these growth rates are a bit stagnant. So overall, it seems like the company's momentum to grow further has slowed down. So in the case of Apple, if we look at the stock price now, it's at a high point. But in the past, when the stock price dropped after being expensive, that was when it was cheap. But now the growth rate has slowed down and the score isn't looking that good. So in terms of the overall score, it's a point where buying and selling could happen. But if you look here, the recent increase in trading volume is mainly because the price is very cheap. So people are buying in at a lower price. If you look at it quantitatively, there are attempts to make changes at the bottom, but there are still lingering downward pressures. So you need to look at it a bit differently than Google. For Google, even in terms of quantitative analysis, the buy signal came out at $154. If you look here now, the 5-day, 21-day, and 61-day moving averages have all shifted to a positive alignment. And in the midterm, the 21-day moving average is above the 61-day moving average. The 121-day moving average is at $168, just $17 above the current price. If the price breaks through $120, there may not be a high possibility for further upward movement.
Now, that's good. Then Apple was actually at risk of moving to the next stage in terms of its growth cycle. So what is the fourth stage? Yes, the fourth stage.
The stage is now starting to decline. It is divided into withdrawal symptoms and cravings.
So first,
I'll talk about the withdrawal symptoms first.